Okay, let's dive right into this explainer. Today, we're unpacking some eye-opening strategies from Stephen W. Bigelow's work on high-profit candlestick patterns. If you've ever looked at the stock market and thought it was just this chaotic, unpredictable mess of numbers, and you're tired of feeling like you're basically just guessing, well, you're definitely in the right place. Standard investing advice can be incredibly frustrating. We're constantly told to just trust the system, right? But today, we're going to see how visualizing raw human emotion can literally transform how you manage your portfolio and finally help you take back control.
But before we even get to the charts, we kind of need to ask a really tough question about the brokerage industry itself. Do Wall Street professionals actually make you money? Because when you look closely at the mechanics of it, their main goal usually seems to be making themselves money rather than maximizing yours. Think about it. Everyday investors are frequently treated as fodder for this massive business machine. The system is perfectly happy for you to accept moderate, safe returns, because that slow, steady drip of fees is exactly what keeps their lights on and their bonuses paid. It's a system built to sustain itself, not to make you exceptionally wealthy.
That brings us to Section 1, the Wall Street Illusion. To really understand candlestick investing, we first have to totally unlearn some of that standard, safe advice pushed by traditional financial experts. We're all taught to blindly diversify and hold, build up this defensive shield against loss. But Bigelow points out that this advice is usually given by people who, honestly, just lack the skill to actively manage and time the market. Look at how this perfectly pits that passive, defensive strategy we're all spoon-fed against the active, aggressive strategy we actually should be using. The candlestick philosophy isn't about protecting your assets by spreading them so thin that growth practically crawls to a halt. It's about maximizing your profits by concentrating your funds in areas that are actually working right now. And hey, if you need proof that blindly holding through the ups and downs can be an absolute disaster, just look at the Cisco warning. Cisco is and always was a phenomenally well-run company with incredibly solid fundamentals. But investors who rigidly followed that buy and hold rule watched in absolute horror as their shares plummeted from $65 all the way down to $18. Imagine the psychological pain of watching your portfolio get crushed, all while your advisor tells you to just hold on for the tax benefits. I mean, why on earth would anyone ride out a 50, 70, or even 90% drop just for a supposed long-term perk? The stark reality is, the market simply does not care what your personal investment timeline is. Which leads perfectly into Section 2, driven by investor sentiment. So if standard fundamentals and buy and hold strategies are critically flawed, what actually drives market prices? What causes those massive swings? Well, the crucial point is right here. The signals are created by the change in investor sentiment. Prices do not move based on a company's raw textbook fundamentals alone. They move based on the perceived results of those fundamentals, driven entirely by raw human emotion. Honestly, the best-run company in the world won't make you a single cent if the collective mass of investors doesn't perceive it to have immediate upside. In the market, perception literally is reality. And this brings us to visualizing that emotion, which is the real secret sauce here. Most of us have felt this firsthand. Think about what panic at the absolute bottom feels like. A stock drops relentlessly until investors finally break, throw their hands up, and scream, "Just get me out at any price." And on the flip side, there's that wild, irrational exuberance at the top, where everyone's convinced a stock is going up forever, so they greedily buy in right at the peak. By recognizing that the masses reliably panic at the bottom and buy exuberantly at the top, we can completely exploit this emotional, wrong-way thinking for our own profit. When everyone else is making irrational, emotional decisions, you can make clear, rational ones. Let's move on to Section 3, Anatomy of a Candlestick. To figure out how to actually capitalize on those emotions, we have to look back at history. And this isn't some flashy new concept. The legendary Japanese Homa family used these exact same visual techniques to build staggering wealth trading rice centuries ago. Just look at the stark contrast here. On the left, you've got your standard Western bar chart. It's thin, it's sparse, and frankly, it's pretty hard to read quickly. But on the right, the Japanese candlestick. The contrasting colors give you a rapid, undeniable visual interpretation of what investors are doing right in that moment. A declining column of dark candles, suddenly interrupted by a bright white candle, attracts your eye instantly. It tells the entire story of the battle between buyers and sellers at a single glance. Let's break down how to actually read that story. The primary feature of the candlestick is the body, that boxed area you see right in the middle. It represents the opening and closing price for that period. If the close is higher than the open, the body is white or empty. If the close is lower, the body is black or filled. It is such a beautifully simple revelation. The very second you look at it, you know exactly who won the day, the buyers or the sellers. No complex math required whatsoever. Now, extending above and below that body are the shadows, sometimes called the hair or the tails. These thin lines map out the extreme highs and extreme lows the stock hit during that day's trading. And this is where it gets really fascinating. These shadows show you exactly how far the panic or exuberance stretched before it finally snapped back. A long shadow means investors panicked or got incredibly greedy and pushed the price way too far before cooler heads prevailed and brought it back to the body. It literally shows you the absolute limits of the market's emotion for that specific day. Put it all together, and these visual cues instantly box in 4 vital pieces of data: the open, close, high, and low. But it's way more than just data. It gives you this new superpower as an investor. In just one single graphic, you get the entire psychological footprint of a trading session. You aren't just staring at boring, static numbers anymore, you are reading human psychology in real time. It's a completely new lens to view the market through, so you can clearly see that fear and greed driving the action.
Let's look at Section 4, Trading with Smart Money. Okay, so now that you can read this basic map, how do we use it to trade alongside the smart money instead of getting crushed with the panicking masses? Well, the immense relief here is that you absolutely do not need to dedicate years of your life memorizing all 50 or 60 possible candlestick patterns. Bigelow's methodology brilliantly boils it down to just 12 major signals. By focusing only on these high-frequency signals that reliably show up time and time again in trend analysis, you completely bypass that steep learning curve. It saves you an immense amount of time and mental effort, cutting right through the noise to get you straight to the highly actionable, high-profit opportunities. And it really all comes back to this profound, centuries-old wisdom from Japanese traders. Let the market tell you what the market is doing. Think about how powerful that mindset is. Are you out there trying to aggressively force your will on the market, or are you actually listening to what it's telling you? Instead of trying to cram a preconceived Wall Street theory onto the tape, you're just naturally reacting to the signals the prices are revealing. When the masses are capitulating in fear and dumping shares at any price, the smart money is quietly, methodically buying. Candlesticks show you exactly when that psychological shift happens. So as we wrap up this explainer, I really want to leave you with this to mull over. Are you going to keep riding the unpredictable Wall Street roller coaster, handing your hard-earned assets over to a system inherently designed to benefit the broker? Or is it time to take back control, learn the visual language of the smart money, and finally, let the market tell you what it's actually doing? The choice and the profit potential that comes with it is entirely yours.